I got Junior with me today. Mama is at her new salon with a couple of appointments. But I want to take a minute today and talk about the spot price of gold historically. And I drew this quick little graph I'll go over here in a minute. But there's a couple things I want to touch on before I get into it. Prior to 1935, gold was at a spot price per ounce. Gold was worth $20. And that was the price of gold. In 1935, the president, Franklin Delano Roosevelt, asked that all Americans turn in their gold coins, and then after that, he raised the price to $35 per ounce of gold, which basically actually stole wealth from Americans and created money, but that's another issue. From 1935 to 1944, obviously it was when World War II was going on. Bretton Woods Act was passed in 1944, which made the dollar the reserve currency for the world. And then in 1971, gold was still at a spot price of $35 per ounce. And then President Nixon, without the approval from Congress, severed the link from gold in 1971, creating a commodity known as the dollar. And so now they could print as much money as they wanted, and the dollar measured in gold would never be stable again. So we look at this graph, and there's a short time period here from a long time period here, but it looks short. This is right here is 1935 to 1971, when we're at $35 an ounce for gold. Right here to here is the 70s, and what happened here is the link was cut here. This spurred inflation. Then we have things like ERISA going on in 1975 getting passed. ERISA was an Employee Retirement Income Securities Act, and what it did was it shifted the responsibility from the company to the employees to provide for their retirement. So this created things like mutual funds, the 401k, IRA, and basically shifted the whole culture of the workplace and retirement. A lot of money was put into the stock market after that, but initially I think a lot of money was put into gold, and that went along with the inflation and really drove that up. Oil was, with all that was going on in the world at that time, oil was shot up. So it's a lot similar to what we're seeing now. It then came down in the early 80s and sat at about $200 to $300 for 20 years until 2002. Now, from here to here is actually just the last 9 years. That's 2002 to 2011 today, for April 21st, 2011. And we're sitting at a per ounce price of gold in dollars is over $1,500 an ounce. So what's happened here is we've seen some different things, but basically we've seen a lot of deficit spending, and it's gotten bigger and bigger, and it got bigger through Bush, and now it's getting a lot bigger through Obama, like really big. What we saw here when it pulled back, we saw .com burst down here at early 2000s. The .com bubble that just burst, and then we saw the housing bubble in 2007 spurred by the subprime mess. That caused a huge crash to the housing market. And then what happened here? It actually went down. Gold went down. I think what was going on here is that people were pulling the trend of gold slowed down a little bit. People had faith in the government. They were going to pull us out of the recession. But things around us didn't get any better, and so things took back off again from 2009 to where we're at right now, and they're just going up exponentially. I mean, if you just look at the graph, we've seen quantitative easing in this time period. We've seen the government's pumping trillions of dollars that don't really exist into the system. Other countries are getting mad at us because we're diminishing our own debt by printing more dollars. But investors around the world are going to gold and silver to protect themselves from inflation, because all the currencies in the world are tied to the US dollar, and we are seeing huge inflation. So I think this trend is going to go up exponentially even from here before I think we'll then see one world currency, and that's another video that you can check out. Scroll through my videos.